Wall Street.
By Governor Lesedi Kganyago, the Monetary Policy Committee finalising its meeting, announcing the interest rates, increasing it by 25 basis points. The consensus was that we were going to get a 50 basis points increase. Nicky Weimar, economist at Nedbank, joins me this afternoon to unpack this. And you were saying offline, Nicky, that the big story here is that grim economic picture that the SARB has painted. And I want us to delve into that in a moment. But let's get that hike out the way. The consensus, as I mentioned in my intro, was 50 basis points. And then the SARB thought, you know what, let's just give them 25 basis points. Maybe just give us a little bit more detail into the reasoning that they would have had in increasing lower than we had thought.
Well, I think, you know, it's very difficult to know exactly what the conversation was behind closed doors. But our forecast also happened to have been 25 basis points. We were a little bit nervous because the consensus was higher. But our reasoning, maybe their reasoning was similar to ours, maybe not. But our reasoning is the economy is in a vulnerable place. Globally, we're looking at a slowdown. The world economy, with China reopening, might avoid recession. But global growth is still going to slow down noticeably during the course of this year. We know in the case of South Africa, we have never escaped the global slowdown. We're a small open economy. Exports and imports make up a big portion of our economy. So that's going to be a drag on growth. At the same time, consumers have taken a lot of strain. During the course of last year, inflation accelerated dramatically. It outpaced wage growth, so their real disposable or purchasing power has deteriorated as a result of that. And on top of that, they've had to contend with a fairly aggressive rise in interest rates. So you take the combination of that, it sort of accumulates over time, and the pressure accumulates over time. It usually takes about 12 to 18 months for interest rate hikes to start impacting economic behavior. And guess what? We're there. We're in that. That's 2023. And then we started this year with load shedding. So if we look at economic growth, we thought, well, we don't have such a weak outlook as they do, but we have growth of 1.2%, so a deceleration to 1.2%. But with significant downside risk because of all of these strains and these pressures, but particularly because of load shedding starting this year at such a vicious pace. So altogether, you've got downside risk to the economy in our view, and at the same time, inflation is receding. Global oil prices have come down dramatically. Global food prices are now actually shrinking. It's a negative territory. You've had the rand. Yes, it's not maybe appreciated as much as some other emerging market currencies, but it's nonetheless proved to be quite steady. And in the final quarter of last year, it appreciated by over 6% against the US dollar. So that's quite a nice pullback. So looking at that environment, to us, it just felt like now's the time to move a little bit slower. It gives you the opportunity, if something goes wrong, to react without pushing the economy into a deep recession.
So would you then agree with the SARB then that the levels that we're currently at are still accommodative? I think the average consumer on the street would probably not agree. But your broad sense of that level?
No, I don't think it is. I think it has been for quite a while, but the moment interest rates went over 10%, we know if interest rates in absolute terms is over 10%, you start to see stress. You know, credit demand starts to slow down. That's starting to happen. You see more distressed borrowing. You see consumers starting to, draw down their savings more aggressively to maintain their living standards. So whenever interest rates go over that 10% in absolute terms, in the banking industry, we definitely start to see stress. So I think we are already we were at 10.5 before we entered into this meeting. Now we're at 10.75. And I think a peak of 11% is probably going to be necessary for them to hike it one more time, 25 basis points in March. But I think at 11%, you're going to be doing the job. You're going to be pushing inflation back towards that 4.5% midpoint of the target range. Going beyond that, I think would place excessive stress on an economy that is really already incredibly fragile, and especially in the light of what's happening in terms of power supply. I mean, the norm now seems to be stage 3 load shedding.
Yes.
And then that's the new normal, and then most days these days at night it's either 4 or 5. So, in that sort of environment, pushing interest rates beyond 11 and then still calling it accommodative, that's not. I don't think
squeeze
that's
an economy
true.
that's already got nothing left to be squeezed off.
Exactly.
So let's focus on that. 0.3%, quite the number that the SARB came up with, saying that load shedding itself, they estimate, would have shaved off about 2% of growth. So whereas they saw previously 2.3% growth, that has completely been wiped out. No doubt that is a very grim picture for the broad economic story for South Africa. What are your thoughts on that?
So I think that's the real story here. That really shocked me. So we've got a couple of scenarios, and one of the scenarios we have is a load shedding scenario. And under the load shedding scenario, we have GDP contracting we believe it contracted in the final quarter. I see the Reserve Bank said they believe there was no growth in the economy in the final quarter of last year. We've got a forecast of minus 0.4%. But in our load shedding scenario, we've got the economy shrinking in the first quarter and in the second quarter, and we've got growth slowing to 0.2%. So if they've got 0.3%, they've got a recession in there.
That sounds
to get to 0.3%,
yeah.
they've got to have a recession in there. But that's not our base scenario. That is our sort of load shedding just stays at 4.5. And we have intermittent spells of 6 for the rest of the year. So that's our sort of load shedding scenario, which suggests to me that that's what they're assuming.
So that's probably one of the reasons they kept it at 25 basis points, so to give them room to maneuver should we reach that.
So say inflation comes down really quickly, all right, then they don't need to move any further, and they haven't moved interest rates to a really punishing level. So that gives them a little bit of space. Say inflation is sticky and it doesn't come down quickly. Again, they haven't moved interest rates up so dramatically at the beginning of the year, so they've got the space to maybe push a little bit more, maybe go another 25, and still be seen to do the job, support the currency, and maybe bring inflation down in the process quicker. So it just gives them scope on both sides of the equation. You know, they've not moved that aggressively that they're now tipping us into recession, and yes, inflation is falling, but it's too late now. We're now shrinking at the rate of knots. At the same time, you know, if, for example, it's not necessary to hike any further because inflation comes down very quickly, then they haven't done too much on interest rates, and it's better for the economy in the long run.
And is this the picture that we're going to start to see globally, Nicky? Because we did see the European Union quite incessant with the fact that they're going to be targeting inflation as much as they can, insinuating a 50 basis points. We saw that 50 basis points coming out of the United States. Are we anticipating that we might see a tapering down from a global picture, given that, as you mentioned earlier, that we do draw on different scenarios when that decision is made?
You know, absolutely. I think globally that is the story. For the US, inflation is coming down very rapidly. Not so much the case in the ECB, which is why I think they are still talking they still have very hawkish language. And all the central banks are going to stay hawkish. So we're in this transition period where the language that's going to come out of the central banks, the rhetoric, is going to be very hawkish. It's going to maybe make people doubt. It's deliberate, without a doubt. They don't want anybody to think they're not serious about fighting inflation. But I think the reality is that inflation globally has turned the corner. It's going to start decelerating. Remember, oil prices coming off an exceptionally high base, right? So inflation is the rate of change. So if you have that sort of drag pulling down inflation globally, it's going to be effective. At the same time, food inflation, we've seen the same trend. And so with time, as growth slows, you are going to see global inflation coming down. But this initial sort of 2-3 months of the year, I can assure you central banks are going to remain very hawkish in their language. They don't want anybody to think that they are easy on inflation, and that is probably the right thing to do under the current circumstances.
Brilliant. Thank you so much for your time this afternoon. That is Nicky Weimar joining us to unpack the decision that was made by the South African Reserve Bank. Daniel, a huge sigh of relief for many households that we did not get the 50 basis points, but no doubt still a lot of pressure on the South African consumer with all the rising costs that we are dealing with at the moment.